Want to be sure you are getting the most out of your retirement? For all the years of your retirement? That's the primary goal of More Living with Jim Brogan and our Dollars and Cents segment, where we provide you with an important financial tip that will help positively impact the quality of your life in retirement. And now, here's Jim with this week's Dollars and Cents tip.
Let's talk about why the 60/40 classic investment portfolio may be broken and may no longer be relevant in today's complex and globally interconnected world. Now, the 60/40 portfolio, that means 60% stocks, 40% bonds. Typically, that's going to look like 60% stock funds, maybe mutual funds and ETFs, maybe a few individual stocks, and 40% bond funds. And normally that means overwhelmingly U.S. bond funds. And to better understand the 60/40 model and why it may be broken, we need to mention briefly modern portfolio theory. Modern portfolio theory was developed in 1952 by Nobel Prize winning economist Harry Markowitz. And he argues that risk-averse investors can construct portfolios to optimize or maximize expected return based upon a given level of market risk. What does that mean? Investors can reduce risk by diversifying assets and asset allocation in your investment portfolio. So we think of the word diversification. The way I like to explain diversification is you have a whole bunch of stuff in the portfolio that if one thing zigs, another zags. So they're not correlated. They might sometimes often be negatively correlated. One goes up, the other goes down. They move opposite. So if one asset fails due to market conditions and goes down substantially, the other asset can either hold its value or rise a little to help compensate for that downturn. Now, the issue is, historically, the 60/40 portfolio, stocks and bonds, had been negatively correlated. So that means when stocks are up, bonds may be down a little bit. When stocks are down, bonds may be up. But in the late 2010s, something interesting started to happen to the stock and bond markets. The markets and the economy emerged from the 2008 global financial crisis, but interest rates were kept artificially low by the Federal Reserve. And it wasn't just here. Nations around the world were seeing prolonged low economic growth, and some even had negative interest rates. Financial regulation became very strict. There was a worry that interest rates were to climb back up. And so the result is that stocks continued to rise while bond values rode with them. And then we had a year like 2022 where stock and bonds were both down double digits. Over the last 4 or 5 years, the diversification of the stock bond portfolio has simply not delivered. The idea is you're trying to reduce risk, and with that volatility, and it has not produced that result of a risk-adjusted positive return. And so that means you probably need a greater level of diversification. You need more things in your portfolio that zig and zag. Maybe that means things like energy and natural resources and commodities. Could mean precious metals, not a big mix, just a hedge. Hedge is a good word to think of diversification. You have little hedges in the portfolio. When you add more of that, it does mean that in a substantial market downturn, you would expect to hopefully lose less money. That also means that in a market boom, you're probably going to make less money. How long has it been since you evaluated the risk in your portfolio and your current diversification? Make sure you're looking at that. If it's been a while, make sure you evaluate your current level of risk and diversification.